So our Lunchtime Stock Club for October 12th, 2020. It's been quite a tumultuous year as we enter into the last quarter of the year. I'm sure a lot of you feel somewhat similarly to me that we can't wait for 2020 to just be done with it, to get it over with, and to focus on 2021 and what comes ahead. But let's take a look at this crazy year to date so far. The S&P 500 is up 8.4%. That feels like not a whole lot of reward considering the turmoil that we all suffered through in March and throughout the summer, but it's eked its way back up to an 8% gain for the year. The EFA index is still struggling. It's down 5.2% for the year. That's the developed market large cap index by and large, and small caps still struggling, down 9% year to date. However, you'll notice on this graph, since the middle of September, the small caps are on an upswing, a little bit higher trajectory than the S&P 500. And in fact, if you look at the last 3 months of the market performance, the small cap 600 index is up 13% compared to 10% for the S&P 500. And even the EFA is up 5.5%. That seems to indicate that maybe their investors are looking for some better values in the small cap segment, especially as large caps seem to be reaching peak valuations. When we look at the PE ratio there, over on the right, you'll see the estimated trailing 12-month PE ratio of the S&P 500 is 35.3. That is up considerably from where we were a month ago during this webinar when the PE ratio was 28. And again, rising stock prices and earnings that are still struggling for many companies as we round out that third quarter are conspiring to push overall levels of valuation up quite a bit, and that is pretty high. That red line will compare the PE ratio to the history of the market. You can see prior to the 1990s, the PE ratio never reached much above 25 until we hit the peak of the bull market that ended in 2000, 2001, and then we saw the market crash. We saw the market crash again in 2007, 2008. In that period, the PE ratio again spiked during that period. I've kind of eliminated that as an outlier, but as the economy went into recession again. And so here we are now in a strange economic situation where investors are still favoring large cap stocks. They're still in the market. They're still investing. They're holding on to it. They're buying on the dips. Everything that they've been taught, except perhaps the reasons that you don't want to overpay for companies, and that I think remains to be a problem. I'm still concerned a little bit about where the market is headed and the volatility that's ahead, but we'll talk about some of that a little bit further along. When you look at the earnings for the S&P 500, again, this is down since last month, so we're down back to where the earnings were in 2007 or so, at just about $100 per share. So that's the aggregate for all companies in the S&P 500. And again, that's using estimated earnings, so it's using estimates for the third quarter, which have generally been improving, but you would never know that from the market. Here's a graph from Zacks, where from the beginning of July through to the beginning of October, the earnings growth estimates, they've always been negative during that time frame, but they've steadily been improving from an expected drop of 26% as we came out of the second quarter to this week, or last week rather, the consensus estimate for third quarter growth for the S&P 500 is for earnings to be down 22.8% in the quarter compared to the year ago quarter. So the outlook according to many analysts, I think, seems to be for performance that will slightly increase. Now, having said that, I still think my personal observation is that we are going to see more of what's been labeled the K-shaped economic recovery. And in that K-shaped recovery, we see different segments of the economy performing in different time frames. So we see a kind of a traditional V-shaped recovery for some companies, some segments of the consumer market, and then we see a much longer phase of recovery where that the downward segment of the economy of the GDP continues to decline and then would start to increase and take a little bit longer than the rest of the economy. In this kind of bifurcated approach to or outlook for the economic recovery, I think is becoming more and more popular. And the reasons that I would zero in on as favoring this type of economic market recovery is that, yes, unemployment is getting better, but it still remains high. It's about twice as many people are out of work right now as is kind of typical or normal. And so that just remains to be seen. Certainly stimulus helped some of those people along, but that can't go on with ever until people get back to work. That's going to hold back a lot of the economy without further stimulus. Certain sectors and industries are going to remain stressed, and there's no sign when they're going to start improving. Headlines recently: movie theaters, remained closed. Has a big impact on Hollywood, on the entertainment industry in general. Just consumers not ready to make the wholesale shift to only getting their content on their tablets, on their computers, on their widescreen TVs, and a profit business model not really set up by the entertainment companies to deliver revenue in that format. Entertainment movie producers make their money from releasing blockbuster films and charging admission for it. And that's just harder to do in a streaming or broadcast environment where your content gets bundled with all sorts of other content, so your share of revenues is much less, right? So that's just one example of a segment of the economy that I think is going to continue to struggle for some point going forward until consumers adapt to a model. And it's a content delivery system that investors or that individuals have balked at since the internet first became popular. When the web became popular in the 90s, there was a lot of people trying to figure out, how do we make this profitable? Advertising was one aspect of it. Then there was another aspect that you could subscribe. And then there was the question of, well, instead of subscribing to a whole website, why can't I just pay for the content that I want to consume? So pay for it on a content piece by content piece basis. And so there were a lot of innovators who were trying to come up with micropayment systems that would make it possible for individuals to consume content. But by and large, that model, whether you're looking at publishing of content and articles, or whether you're looking at music publishing or purchasing and consumption of music, has just never really taken hold. Yes, people will pay for a Spotify subscription, for instance, or an Apple Music subscription where you can consume all sorts of things, but that makes it very difficult for content creators to actually make their money back, with the exception of the most popular artists. And the same thing is happening across the publishing industry. So that's just to say, when we think about this, when we look at the analysis, there's no sign or no indication that we're going to see wholesale shifts in consumer behavior on a time frame that's going to help a lot of these businesses. So those are big question marks. Certainly cruise lines remain problematic, travel in general. remains problematic. Certain restaurants, certain types of restaurants remain problematic as we head into the winter in the northern part of the U.S. That's going to have a big impact on the ability of a lot of restaurants that have been relying on having a patio set up. They're just not going to be able to do that. And with the pandemic still raging, which brings me to my third point, is the risks of a second wave appear to be growing. Again, I'm not projecting, I'm not predicting, but when you look across the country at the various hotspots, at the various the incidence of cases, that's very troubling, because that's going to have a big impact on economic recovery if states have to turn around and go back into lockdown after opening up too soon, not doing enough testing, not mandating masks. So that's a big risk for economic recovery. I think that's a bigger risk to economic recovery than shutting down for a time, for businesses to shut down, give the virus a chance to get stomped out and to delay transmission or inhibit transmission. And so I think we're looking at a more prolonged period of economic recovery. And then fourth, the fact that there's no stimulus package on the table. It doesn't appear that we're going to see anything this month in terms of stimulus, and that just puts people further into the hole. If people are spending off their credit cards, they're going to have to pay those credit cards off. That costs more. That means they'll have less money when they do return to work, for instance. It means that foreclosures might increase. It puts all kinds of risks in the financial sector. The fact that we've got this delayed recovery without stimulus helping things along. And so I'm prepared for this sort of longer term recovery as we head into this election season. And that's the next thing that I want to talk about, is the market and the upcoming presidential election. We are just about 4 weeks away as of tomorrow from Election Day. Oh, I'm sorry, 3 weeks away, 30 days away from October 12th. Yeah, so we are very close to the election. And traditionally, election years have had some pronounced impacts on the stock market. So doing a little history, looking at history, we've certainly seen some of those in the past. But right now, a lot of the pundits are looking at the markets with respect to the election and possible outcomes of the election. The Wall Street Journal last week or the week before published an article that stated that investors are betting on one of the most volatile U.S. election seasons on record, wagering on unusually large swings in everything from stocks to currencies as they brace for what could be a weeks-long haul of unpredictable events. Again, shades of the Bush-Gore election, where results were still being debated for some time after Election Day. And I think everyone is prepared for that possibility. Not saying it's going to happen, but I think realistically we have to look at a very close race and how that might impact the markets if we have to sit around and wait for the courts to intervene, for various states to complete the process. The Financial Times last week said that ahead of a potentially disputed result on November 3rd, fund managers are casting around for new harbors to shelter from a potential storm. So both of these articles and others were looking at how professionals in the market are looking to manage risk and volatility going into the month of October. Trying to protect from negative outcomes that might impact the market. And with that, just with the uncertainty and a potential for conflict and a lot of disruption to the, even worse than the disruptions we've seen societally in 2020. And so what do we do as investors? Well, let's think first about the presidential election market cycle. According to the Stock Market Traders Almanac, the last 2 years of the 45 presidential administrations since 1833 produced a 742.5% gain. The first 2 years of those administrations only produced 326% gain. So the biggest stock market gains come in the last 2 years of the presidential administrations. When you look at the Dow in election years itself from 1949 to 2018 on top in red, when the sitting president is running for an election, as the year goes on, the Dow performance increases, the percentage change goes up. When there's all election years is the black line in the middle, and when there's an open field where there's no sitting president, then that's the line on the bottom, the dotted line, where all bets are off and there is no month in which the market ekes out a gain. Again, the market doesn't like uncertainty, and when we have a lot of uncertainty, the market responds very negatively. In October, this is where we are going forward. This is again from Jeff Hirsch of Almanac Trader, the publisher of the Stock Market Traders Almanac. This graph shows you the performance in October, the average performance of various indexes. So the Dow is in red, the Nasdaq's in blue, the Russell 2000 is in black, the S&P 500 is in green, and the Russell 1000 is in purple. The dotted lines at the top are without the October 2008 performance. If you recall, October 2008, the markets had a terrible month. That was the start of we're in the midst of another bear market, and so if you take out those years, you see the dotted lines are up above. The black. The bottom lines, the solid lines at the bottom, include 2008. But even so, in very few of these indexes, in the either excluding 2008 or including 2008, ended October up more than a fraction of a percent. And so, yeah, that's pretty miserable performance for October. And again, I come back to the market just doesn't like uncertainty, and that's going to drive this particular year. Also, some other statistics, election year Octobers rank dead last for performance by the Dow, the S&P 500, and the Nasdaq, the Russell 1000, and the Russell 2000 for all periods for which data is available for those. Eliminating 2008, however, the rankings climb to mid-pack of all of the months. So not the worst, not the best, somewhere in the middle. But as Jeff points out, should a meaningful decline materialize in October, it is likely to be an excellent buying opportunity, especially for any depressed technology and small cap shares. So, again, the light at the end of the tunnel, and that's what investors have been doing, buying on the dip, and that's pretty good. But if you're confused and you're looking at the market and you're looking at the prognosis, you're not alone. The part of the problem is that the markets don't know what to do about the election, said Gershon Distenfield of AllianceBernstein. We have all been humbled in prognostications of markets given recent experiences. That's a rare acknowledgement from a financial expert who says most financial experts don't really haven't been able to claim a whole lot of success in recent times. Again, this level of uncertainty and volatility remains, and it's probably increased quite a bit. VIX has done very well in periods where the market is tanking, as traders kind of bet on volatility. There are strategies like straddles that are increasingly being put into play, and the irony of it all is that as more and more traders are making bets using the VIX volatility index, it actually increases volatility of the market because they're moving money out of the market into the VIX and betting against the market. So they're actually, when enough of them start to do that, it creates additional volatility in the marketplace. So how does this affect you? Well, 4 tips. These are Doug's tips for coping with election year turmoil. First of all, we never act as a result of fear or panic with our portfolios. We want to, remain level-headed and understand that these are temporary changes. These are temporary situations. They shouldn't affect your long-term prognosis. Secondly, remember that patience is a great defense for dealing with market volatility. A lot of people who make bad decisions in the face of market-changing events do so because they can't take it. And that's not a valid reason to make a change to your investment strategy. Yes, perhaps over the long term, if you've decided that this increased level of volatility is keeping you up at night, if the stocks that you're holding are worrisome and giving you anxiety, well then yes, let's make some tactical or some strategic changes rather to your portfolio, not change up your tactics every time something occurs. Then you're reacting to the markets instead of preparing for all contingencies. And so my approach is number 3, continuing to think defensively with your stock selection. Now, we're not necessarily defensive in terms of our asset allocation. We're not talking about being defensive in terms of moving to cash, moving to the sidelines. I'm just saying there are some segments, some sectors, some industry groups that will attract capital during difficult periods of the market, the economy, and having a healthy exposure to defensive stocks can be a very, very, very smart thing to do. Yes, it's not going to prevent you from seeing paper losses when the markets go down. However, over the longer term, it's going to allow your portfolio to come back faster. Your losses may not be as deep as the broader market's losses, and that's the objective in the near term for long-term focused investors, and then count on your long-term outperformance to exceed those market averages, and that makes it all worthwhile. Right now, step 4, you should be starting to think about the year end, not only just hoping that it will get here sooner rather than later, but also start to think about gain loss tax harvesting prior to year end. If we do expect some additional volatility, if you are sitting on some stocks that have performed very, very well, and perhaps those PE ratios seem to be much higher than average, they bounced back from the March decline, and you're sitting on some capital gains on paper, start to think about perhaps setting some stop limit orders on those particular companies, offsetting them with some capital gains losses that you'll trigger by selling stocks that you're holding at a loss, and to kind of balance out and think about as we head into year end, instead of waiting for the market to take a turn, if there are some things that you would say, well, I wouldn't mind selling this stock and selling this matched pair of stocks, one that I'm holding at a loss, one I'm holding at a gain, and then think about repurchasing if you have the opportunity in the next couple of months. When you think about it, if you sell a stock that's 5% off its high as it starts to tumble to 10 or 15% down, yeah, you give up a little bit on the upside. However, as one lesson we have learned from the last couple of years in the market is that anytime you think you've missed an opportunity to buy a stock, you get an opportunity at some point within a fairly short period of time, and that's part of the increased volatile nature of it, and certainly what we saw earlier in 2020 with a massive correction, bear market swing, followed by a subsequent upswing, and I would expect some more of those events to happen. I'm surprised that we're not seeing. Well, I'm partly surprised that we're not seeing an extended bear market triggered by the pandemic. But again, low interest rates are keeping people in the market, and the fact that there's no alternatives to stocks just means there's a lot of capital that needs to be deployed without a lot of places to deploy it, and that I think is helping boost the market and keep it going up. So at any rate, those are just some ideas to kind of keep in mind as we go forward. In my, let's see, my November Investment Club webinar, we'll be taking a look at capital gains loss harvesting in a little more detail, provide some rules, the tax rules, and look at it from that perspective, and kind of do a deep dive into why it makes sense for clubs and individuals to take advantage of that. So keep that on your schedule if you're interested and involved in an investment club. So with that, I'm going to turn to, let me look at some of the questions here. Dennis says it would be interesting to look at the November charts post-election. What happens once the election is decided? How do the markets perform? Yep, that's probably a good point. We'll look at that maybe for our next month. I'll see if I can track that down. Yeah, Dennis says, does this October seem normal as far as historical Octobers? Yeah, that's a good question. Where are we? We're down a little bit from the highs in September. And again, there's something of a foregone conclusion for many on Wall Street, the traders especially, if the trope is Octobers are bad times, and certainly, when we look at big market declines, the Black Octobers, those have happened. Black Tuesday, for instance, those happened in October. So there's a memory there, and so that kind of feeds into it. And again, just the increased volatility as we head into it. So I didn't look at the month-to-date figures for the market, but my sense is, based on where things have been in the last couple of weeks, that we are still being held back a little bit there. Okay, Shirley asked about the K-shaped market. Please review this. The K-shaped, if you've heard about the V-shaped economy, this is where the GDP declines and then it returns. So returns to to where it was before in sort of a V formation. So let's see. I'm just trying to see if I can find a graph. I've got one in that I've covered in some of my presentations in the past. Here's a real quick one, just for illustration purposes. This is a V shape, right, in a market index. So where the market drops and then it recovers. And this is what our recessions tend to look like. We see the GDP drop for a couple of quarters, typically up to, in the recent history, that's been a 3 to 6 quarters of declining GDP, and then it starts to take off again, and so then we see the increase in GDP, and it forms generally sort of a V shape. If it's an extended economic downturn, it might be a U-shaped recovery where we see the recovery taking much longer. There's W-shaped recoveries where we see a little bit of an uptick and then the market falls again, and then we see it coming back up, like 2 V-shaped recoveries, which is a little recovery in the middle of it. The K-shaped recovery essentially says that we'll see this sort of formation for big chunks of the economy, but others are going to continue to drift down, and we won't see their recovery for many months until after the rest. They won't catch up for many months. So just a way to think about recovery of the economy. So for our stock study, we're going to take a look at a stock that was in the investor advisory service in the September issue, and this was at the end of August. I see that price there. United Healthcare, ticker UNH, is the largest private health insurance provider in the U.S., 50 million members across the U.S. and international businesses. So that's a pretty significant number relative to the U.S. population. It was recommended in September 2020 in our investor advisory service newsletter, around $320 per share. Today, it's somewhere around $331. So in a couple of months, it's gone up a little bit, but not. It still seems like there might be room to grow. As a healthcare insurance operator, this falls into the healthcare sector, and the healthcare sector is one that I would consider to be defensive. And so defensive sectors are where you want to be. And United Healthcare is due to report earnings later this week for their third quarter. And we'll talk about that as we go through some of the points here. Here is their graph, where you see their historical and projected growth going forward. The uptick in the second quarter for pre-tax profit and earnings per share that you'll see here. Here, I'll just grab my pen. And this quarter right here is due to the pandemic, because a lot of non-essential healthcare got put off in the second quarter. So March, April, April, May, June, a lot of people were not going to the doctor for anything other than emergency care. A lot of medical offices were shutting down except for emergency care, and a lot of non-essential surgical procedures weren't happening. So when that happens, a company like United Healthcare didn't have to pay out as many claims. They were still collecting premiums for employees, but they weren't paying out as many claims, and so they saw their earnings or their sales remain pretty stable, but earnings did a big uptick. We would expect in the third quarter, we're going to expect that earnings are not going to show that same percentage change as they did in the second quarter, as people are going back to the doctor. However, it did point out one of the advantages of holding companies like United Healthcare. Here is their quarter by quarter pre-tax profit graph, where you can see them about 7% of every dollar of revenue becomes earnings before taxes, and that jumped up to over 12% in the second quarter. We're going to expect that to decline, but that's a nice profitable quarter. And to show how that compares to some peers, here is the pre-tax profit margin since 2010. In blue is United Healthcare. The peers here for comparison purposes include Anthem in the yellow gold color, Cigna in green, and Centene, which is slightly different type of insurance business. They focus on the Medicare, Medicaid government reimbursed market, so lower margins there in red down below. But you can see Cigna seeing margins decline, Anthem relatively stable, a little bit of an uptick, but lower than United Healthcare's. And so that's a very favorable comparison for United Healthcare, bumping back up a little bit since 2015. Debt to equity, again, compared to peers, certainly Centene's debt increased, Cigna's debt jumped up, Anthem's debt is a little bit lower and kind of on this and declining a little bit from United Healthcare. But again, this is an industry where there's a lot of debt relative to equity, and so we wouldn't penalize them for that particular aspect of their balance sheet, and you can see how it compares to other similar businesses. So they're in the mix. It's pretty solid. The PE ratio history here shows the high PEs ranging from 21 to 23 in the last 5 years and 14 to 17 on the low side during that period. Current PE ratio as of this morning was 18.6. The average PE ratio is 18.7. So this is that PE of 18.6 is right in the average, right in the ballpark. Point out that United Healthcare processed about $1 trillion in claims last year and are the largest healthcare provider here. And this is a slower growth business, but those PE ratios are high relative to other financial stocks. But this is a pretty high quality business all in all. In 2010, when we look at the historical graph, you see there was no real deterioration of the profits or sales for United Healthcare. That's when the Affordable Care Act went into place. And a lot of people were concerned it was going to negatively impact the business of healthcare insurance companies, but generally all of the healthcare insurance companies figured out that, yeah, they could make money under the Affordable Health Care Act and maybe even help their business. So this is a company that's not going to go out of business. They are almost like a utility in that nature. Competition is there are not a whole lot of new companies starting up that are going to compete with a company on the scale of United Healthcare. Certainly the changing shift of the healthcare industry in terms of government-supported healthcare, or what the company's going to do about rising healthcare costs, which have really outpaced inflation in recent years. And despite all of the efforts of insurance companies to manage the costs of care, still companies and individuals are seeing their insurance costs go up. And so there's a big question that we have to ask is how long is this going to be sustainable, and what can be done over the long term to manage the costs of care for individuals as well as for companies like United Healthcare. So the relative value right about average. Looking at section 4, this is looking at a high price of $550 from where it is now, $330, and a downside price of $273, and that's a pretty low downside price. I could see that setting a little higher as you go forward, but that puts the buy range buy up to $343 at just under a 4-to-1 upside downside ratio. However, the total return is just about 12.2%. So it's a lower return company with 1.5% current yield. And again, that's a pretty stable yield there. We'd expect that maybe to go up a little bit over time, but 12% below our 15% target, according to the math. That little eye icon there has the 3-to-1 upside downside ratio, and 15% total return. Buy price would be about $291. So definitely a buy on the dip opportunity, or dip your toe in right now if you were interested in kind of diversifying a little bit into this particular sector. We don't often have opportunities to buy a high quality healthcare insurance business like this, where they are making a lot of money. Look at the cash flow. You can see that earnings are supported by the cash flow, and there's a lot of attractive stuff about the particular business there. The on the growth projection in the investor advisory service, they were projecting revenue growth of around 12% a year, with sales growth on top of sales growth of around 8% a year, looking at some continued margin expansion and share buybacks to help boost the earnings per share range and of growth a little bit higher going forward. So I just thought I'd throw that out there. A a lot of the companies that have been in the investor advisor service in the last couple of issues have been companies that we also feature in the SmallCap Informer, and I think that's again the strong performance recently of small cap stocks, and we would expect small companies to perform a little better as economic recovery takes hold. Small company stocks are kind of first out of the gate. It just takes a little bit of upward movement in the economic trends to see those small company stocks continue to outperform or to translate that economic progress into earnings, which drive share prices. But this is a large cap, definitely a large cap stock that, again, could be a nice core holding for a portfolio. Walter says, would the repeal of the Affordable Care Act affect this particular company? And I think most analysts would agree with my assessment is that no, that what we've learned is that companies like United Healthcare are going to make money no matter what. They might see, but it's been 10 years now of the Affordable Care Act. If there was a wholesale repeal, we've been promised that there would be a new, better plan. Right? That's the political promise of the repeal of the Affordable Care Act is that we'll have better government health care. I don't know if that's possible, if that's an oxymoron, but I think the bottom line would be companies like United Healthcare will make their money no matter whether governments pay for it, businesses pay for it, or individuals pay for it. It's just the mix that kind of switches things up. And I think that that's a key takeaway for a business like this. All right, as I mentioned, the total return analysis, 12.2%. Again, we wouldn't sneeze at a 12% return per year for a stable growing core holding like United Healthcare. And then again, if there's an opportunity where the price drops down, this is maybe one to put on a watch list. So I've looked at the questions. I see Ed's got some questions about take stock on the Stock Central website, and where do the earnings and revenue forecasts come from? We have an algorithm that was developed for the Take Stock tool, which looks at the historical growth primarily, and will also take into consideration analyst estimates. Analyst estimates are only available for about a quarter of the companies in the data, the Morningstar data service that we use. But the algorithm looks at the historic, the long-term historic, the short-term historic, the recent growth rates, and then it makes a projection of growth. So it tends to be very conservative because it won't exceed any of those values, and it takes into account the volatility of the growth of sales and earnings as well as the underlying values. So it will penalize for companies with inconsistent growth rates, and then it creates those. So there's help documentation for Take Stock that will talk a little bit about the routines, and certainly it's covered in the Take Stock book, which talks about it as well. But again, Take Stock is designed, the automated sort of semi-automated stock analysis function of Take Stock is designed for new investors to prevent you from getting into a hole where you expected growth at a much higher level than is likely to be experienced by the company in the future. And then for experienced investors, then you can go the next step in the tool and apply judgment as you would do with Toolkit or with the SSG plus and better investing, and make more decisions about overriding the provided judgment in the tool. The thinking is that if you're always very, very conservative, you might miss out on the upside in many cases. However, you're going to limit your losses on the downside by really just dialing in to companies that have very consistent growth and great track records going forward. So we've got a busy fall schedule. Taking a look. Al mentions he's looked at take stock for Amazon and Apple today, and it just it just spits it out and says these stocks are just not worth looking at right now. The P ratios are too high relative to the growth, and as Al points out, their momentum plays. Yeah, they're again. We like those companies when we can buy them at an attractive price, but if they're not at an attractive price, we don't buy them. And Take Stock is trying to prevent you from buying unattractive stocks at attractive prices, which is, again, not a formula for success. So I've got a lot of virtual events coming up, 2 money shows, e-money shows coming up, the Northern Texas chapter, the Northern California chapters, kind of coalition there, and the Puget Sound chapter. I would have been traveling to many of these places, but now they're all online, which means that anywhere around the country can participate. And the Philadelphia chapter in December. So got those scheduled. Had a great time at the Virtual Investor Conference last week talking about OTC markets and an area where there are a lot of underfollowed companies. So I've been doing some research trying to find some new opportunities for our small cap investor newsletter and for other places where we look at sort of underfollowed stocks on Wall Street, stocks beneath the Wall Street radar, see if we can get in and find some values there, since it's so hard to find values in the major markets, given all the volatility and the excitement that seems to build up. But our SmallCap Informer newsletter continues to chug along, and it's performing quite well. So I invite you to check that out. And hopefully we will, I'll be showing you some more tips and tricks from the small cap market in the next couple of weeks there. Well, as always, keep calm, stay the course. We'll see you in November, and don't forget to vote. It's very important. Everyone needs to participate. It's shocking that 100 million Americans don't vote every year, so I invite you and urge you to exercise your civic duty and cast your ballot in the November election. We'll see you right the next week. We'll see you back at our Monday Lunchtime Stock Club webinar. So until then, stay the course, keep calm. We'll talk to you soon.